Listen, we've been analyzing real estate markets for over 2 decades, and we need to share something with you that's keeping us up at night. The Federal Reserve just pulled $2.4 trillion out of the markets through quantitative tightening, the largest monetary contraction in history. But that's not even the scariest part. Right now, as we're talking, the U.S. government is paying over $1 trillion annually just in interest payments alone. And if you think that doesn't directly impact your real estate portfolio, you're making a dangerous mistake, my friend. But here's what's really got our attention. While everyone's focused on the Fed's massive pullback and those trillion-dollar interest payments, there's something much more immediate happening. Smart money, the kind of institutional investors who move markets, they're quietly rotating out of one major asset class and into another. We'll show you exactly what they're buying and selling in just a few minutes. And there's a third piece to this puzzle that most real estate investors are completely missing. There's one specific type of property that's showing delinquency rates of nearly 7% right now, 6 times higher than normal. If you own this type of real estate or you're thinking about buying it, you need to know what we're about to tell you. Here's exactly what we're going to cover in the next 10 minutes. First, we'll break down what the Fed's $2.4 trillion pullback really means for real estate and why our $38 trillion debt crisis is creating both massive risks and hidden opportunities. Then we'll show you the actual data on foreign money movements, including why China's $300 billion treasury dump isn't the whole story and what it means for property investors. We'll dive deep into the banking system and why commercial real estate is facing its biggest crisis in decades, while residential presents surprising opportunities. And finally, we'll give you our specific recommendations for positioning your real estate portfolio right now, what to buy, what to avoid, and why timing matters more than ever. Let's start with what the Fed's historic pullback means for us as real estate people. When the Fed pulls $2.4 trillion out of the financial system, they're essentially draining liquidity, making money more expensive and harder to get. But here's what most people don't realize. Their balance sheet is still 60% larger than before the pandemic. And now we're dealing with the consequences of both the initial money printing and the dramatic pullback. And that brings me to the numbers that should terrify every real estate investor. The national debt just hit $38.43 trillion. Now you might be thinking, okay, big number, but what does that actually mean for my rental properties or my house? Here's what it means. We're now spending $8 billion every single day just adding to that debt. That's $112,966 for every person in America. Or if you're a family of 4, you're on the hook for over $250,000. But the real killer is the interest. We crossed $1 trillion in annual interest payments for the first time in history. Think about that. We're paying more just to service our debt than we spend on defense, more than Medicare, more than the entire government agencies combined. And that interest rate? It's consuming 18.4% of all federal revenues. Here's why this matters to your real estate investments. When a government is spending nearly 1 out of every 5 tax dollars just on interest payments, they're going to find ways to get more money. That means higher taxes on property owners, potentially through property taxes, capital gains, or rental income taxes. It means inflation as they print more money. And it means they're going to be looking at real estate, the largest store of wealth in America, as a source of revenue. Now, let me address what you're probably hearing in the news about foreign countries dumping U.S. debt. The headlines are scary, but the reality is more nuanced, and it actually creates opportunities for us. Yes, China has been selling. They're down to $682.6 billion in treasury holdings. That's a 47% drop from their peak and the lowest since 2008. They've sold $86 billion just in the past year. But here's what the media isn't telling you. Total foreign holdings of U.S. treasuries actually increased to $9.355 trillion. Japan bought more, the UK bought more, major financial centers bought more. So what's really happening? China's diversifying into gold. They've been buying gold for 14 straight months. Smart money is hedging against dollar risk, but they're not abandoning dollar assets entirely. They're just being more selective. For us as real estate investors, this creates a fascinating dynamic. Foreign money that used to just park in treasuries is now looking for real assets. Real estate, particularly in stable U.S. markets, becomes more attractive. But you have to be careful about where that money flows. Speaking of money flows, let me show you something that should grab your attention immediately. The Federal Reserve ended quantitative tightening on December 1st after pulling that $2.4 trillion out of the system. They've cut rates 3 times and are holding at 3.5 to 3.75%, but inflation still running hot at 2.7% to 2.8%, well above their 2% target. What does this mean for real estate? It means we're in this weird environment where rates are coming down, but inflation is sticky. That's actually historically good for real estate owners. Your mortgage payment stays fixed while your rental income and property values tend to rise with inflation. But timing matters and property type matters even more. Let me tell you about the stock market situation because this directly impacts where money flows into real estate. The Shiller-Cape ratio, that's the cyclically adjusted price to earnings ratio, just hit 40.8. The only time it's been higher was December 1999, right before the dot-com crash. We're at the 99th percentile of all historical valuations. The Buffett indicator, which measures total market cap to GDP, is sitting at 230%. Warren Buffett himself says anything above 120% signals overvaluation. Here's why this matters to you. When stocks are this overvalued, smart money starts looking for alternatives. Real estate, particularly cash-flowing real estate, starts looking very attractive by comparison. We're already seeing this rotation beginning. Real quick, if this market intel is helping you make better decisions, hit that notification bell. We drop new housing data every week, and the viewers who catch it first get the best opportunities. The bell ensures you see everything immediately, not days later when the market's already moved. But not all real estate is created equal. Let me tell you about the danger zone. Remember I mentioned that one asset class showing 7% delinquency rates? It's commercial real estate, specifically office buildings. Commercial mortgage-backed securities delinquency rates have hit 6.59% to 7.29%. That's 6 times higher than bank loan delinquency rates. Office vacancy rates are running about 19.4% nationally. Here's the math that's killing office building owners. $957 billion in commercial real estate loans matured in 2025. These owners are trying to refinance at rates that are 3 to 4 percentage points higher than their original loans. A building that was cash flowing with a 3% mortgage is suddenly bleeding money with a 7% mortgage. If you own office buildings, especially in secondary markets, you need an exit strategy. If you're looking at office buildings as investments, understand you're essentially betting on a return to pre-remote work patterns. That's a bet I wouldn't want to make. Now, let me tell you what's actually working in real estate right now. Residential real estate has cooled significantly, but in a good way for smart investors. Home price growth has slowed to just 1.4% year over year. That's a 14-year low. Meanwhile, mortgage rates have dropped from over 7% to about 6%. This creates opportunity. Sellers who were holding out for peak prices are starting to get realistic. Inventory has improved to 3.3 months of supply, still below the balanced 6-month level, but better than it was. For investors with cash or access to financing, this is starting to look like a buying opportunity, especially in markets where fundamentals are strong. But here's what you need to understand about the consumer side of the equation, because this affects demand for rentals and home purchases. Consumer confidence just collapsed in January 2026 to 84.5%, the lowest reading since May 2014. The expectations index fell to 65.1, which historically signals a recession ahead. Credit card debt hit a record $1.233 trillion, with 47% of cardholders carrying balances. The personal savings rate has fallen to just 3.5%. Here's the translation. People are struggling financially, which means rental demand should remain strong, especially for affordable housing. But it also means they're less likely to buy homes, which keeps the rental market tight. If you own good rental properties in decent areas, you're positioned well. Let me address the banking situation because this affects everything we do in real estate. The good news is that bank failures remain minimal. Only 3 small banks failed in 2025, and the FDIC problem bank list is down to just 57 institutions. The banking system is actually quite healthy overall. Unrealized losses on bank securities portfolios have improved significantly, falling to $337 billion from a peak of $482 billion. But here's the concern for real estate investors. Banks are being much more conservative about commercial real estate lending. They're seeing those delinquency rates I mentioned, and they're pulling back. This creates opportunity for private lenders and cash buyers, but it makes traditional financing much harder for commercial deals. Residential lending remains available, but banks are being pickier about debt-to-income ratios and requiring larger reserves. If you're planning to expand your portfolio, make sure your financial profile is squeaky clean. Now, let me resolve that question about what smart money is actually buying and selling. The institutions are rotating out of overvalued stocks and speculative commercial real estate. They're moving into gold. Central banks bought 863 tons in 2025. And gold hit an all-time high of $4,218 per ounce. They're buying stable, cash-flowing real estate in primary markets. They're accumulating farmland, industrial properties with long-term leases, and residential rental properties in markets with job growth. What they're avoiding: office buildings, retail in declining areas, anything that depends on appreciation rather than cash flow, and anything in markets without strong employment fundamentals. Here's our bottom line recommendation for real estate investors right now. First, if you own office buildings or retail, seriously consider your exit strategy. The fundamentals have changed permanently, not temporarily. Second, if you're looking to buy, focus on cash flow over appreciation. In an environment with $1 trillion annual interest payments and potential inflation, you want properties that pay you to hold them. Third, consider geographic arbitrage. High-cost markets with overvalued stocks create cash that needs to find a home. Secondary markets with strong job growth and lower entry prices are starting to look very attractive. Fourth, build your cash reserves. We're seeing signs that point to potential recession, not guarantees, but warning signs. Cash gives you options when opportunities arise. And finally, remember that real estate has historically been one of the best hedges against exactly the kind of fiscal and monetary instability we're seeing right now. Your mortgage payment stays fixed while inflation potentially pushes rents and property values higher. The key is being selective and understanding that we're in a period of significant change. The strategies that worked in 2021 won't work in 2026, but for investors who adapt and focus on fundamentals, there are real opportunities emerging. What questions do you have about positioning your real estate portfolio for what's coming? Drop them in the comments below, and we'll address them in the next video. And if this analysis was helpful, hit that subscribe button and notification bell. These economic shifts are happening fast, and we'll be tracking them for you. The smart money is already moving. The question is, will you move with them, or will you be asking later how you missed the signs? We'll see you next time.